What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about a Verizon Communication, ticker symbol VZ. They just reported their Q2 earnings and gave a little bit of updates on guidance before the bell today. We're going to jump into those numbers here in a moment. Take a look. It was actually a really good quarter. We'll also take a look at the stock chart as well with this one. This one has been in a pretty well-defined downtrend. We'll talk about, is there an opportunity for this one to break up? And then we'll compare very quickly Verizon to AT&T to T-Mobile. We'll talk about the trend that we're seeing, at least in the business models that Verizon and AT&T are doing, I think, to become more like T-Mobile, believe it or not. Now, we talked about Verizon and its stock chart. Look, over the last year, this stock's dead flat, up just down actually 0.5%. Over the last year, again, just dead flat. You are collecting a dividend on this one, and if you are an income investor, not necessarily a bad thing to collect 4.5% or $2.51 per share. But there are other stocks out there and REITs and things like that that are paying a comparable dividend, and you're actually seeing capital appreciation. So could Verizon be on the verge of finally breaking out to the upside, because we've been locked in sideways action for 5 years on this stock? Well, one sign that it could potentially be around the corner is that they did raise their profit forecast. They were sitting about $5 and $5.15 per share. They upped it during their Q2 guidance today to $5.25 to $5.35. The consensus was sitting at right at $5.14 per share. That is pretty strong revenue growth, and we'll talk about that here in a second. Now, in terms of T-Mobile, so if you're as an investor, you have a choice. If you want to invest in 5G or mobile, phones and things like that, you got a choice. You got T-Mobile, you got AT&T, and Verizon. Those are basically your choices here in the United States. Now, I pulled up a price to sales chart. I stretched it back 3 years. At one time, not too long ago, they all converged in this almost 1.5 to 2 times sales. But now we've seen over the last year or so, T-Mobile has really broken out, and they're trading at over 2 times sales. And AT&T is sitting at 1 time sales, and Verizon sitting kind of right there in the middle at about 1.78 times sales. What we've seen from Verizon and AT&T is the combination of them both trying to shed assets not related to internet and mobile communications. Okay, AT&T, in their case, getting rid of Time Warner, getting rid of parts of DirecTV, those types of things, becoming more of a pure play communication company again. Same thing with Verizon. What we see with them over the last couple months, they shed the Yahoo and all their kind of digital media assets. They shed those, they sold those off to private equity. I think in an attempt to start getting the valuation that T-Mobile is getting, because T-Mobile stock has appreciated tremendously and they don't even pay a dividend. So we'll see what happens in the coming months. Could potentially mean that Verizon and AT&T catch up with T-Mobile now that they're starting to become more pure play communication companies. We'll see if that's possible. Let's jump into the statement of income. So here's our profit and loss statement with Verizon. We've got our operating revenues up here. We've got our service revenue here. Our left-hand column is the last 3 months. The column next to it is the 3 months of the previous period. So a year-over-year view on a 3-month basis. Our right-hand column is year-over-year just from a 6-month basis. So we see our total operating revenues coming in really hot, okay? Nearly 11% growth. We went from about $30.5 billion up to this $33.8 billion. For the 6 months, we're about 7.4%. That's strong revenue growth. Look, 10% revenue growth year-over-year on a quarterly basis is pretty good for any company outside of maybe your high-filing tech stock. So for Verizon to put up that kind of number is showing that their business is doing quite well. Now, we've got these operating expenses as well. Those grew almost identically. Okay, you see our operating expenses here. Those grew 10.9% as well, but our operating income ticked up nicely, 10.9% as well. Just steady company here. Went from $7.3 billion up to $8.1 billion. On those 6 months, it actually paints an even better story because they controlled cost even better for the last 6 months. Their operating expenses only went up 5.4%. That shot our operating income for the last 6 months up 13%, from about 14 billion up to close to 16 billion dollars. Now that takes us down after we pay some interest on the debt, which is not an insignificant thing, although that went down 22% in the quarter and about 8% over the last year. You gotta love low interest rates here. If you're a corporate environment, you paid only $844 million on this debt. We'll talk about that here in a second. That gives us net income about $6 billion. That's up 23% over the last year. That's absolutely phenomenal. So just really, really strong from an earnings per share basis. You're coming in at $1.40. We talked about how we pay $2.51 per share. So just really strong dividend coverage on this one as well. Now let's take a look at the balance sheet. Take a look at that massive amount of debt that this company has, and we'll take a look at some other things as well. So the right-hand column is basically the beginning of 2021, and we've got 6 months into it right here. And we see the right-hand column is kind of the change. And the big thing that jumps off the board, and it should jump off to you as well, is cash and cash equivalents went down $17.5 billion. So despite bumping up our net income number, bumping up our operating margins, our cash and cash equivalent flew out the door. And so we got to see where that went to. We went down from $22 billion all the way down to $4.7 billion. About the same in receivables. All things being considered, our total current assets went down quite a bit, about $19 billion over the last 6 months. Now, our total assets went up a little bit. It looks like maybe we poured some of that money into wireless licenses, deposits for wireless licenses, and things like that. You got to say that really slow unless you want to slur your words. So we've seen that they've pulled cash from the top of the balance sheet and started putting it into some of these other assets down here. Now, let's take a look at this long-term debt as well. That ticked up big time, okay? We ticked up over the last 6 months, $21 billion, okay, from 123 up to 144. That's not 144,000. This is not $144 million worth of debt. This is $144 billion worth of debt. Okay. And this is just long-term debt. We've got debt maturing within 1 year. That is up $1.1 billion as well to $7 billion. All things being considered, you've got blended together well over $150 billion with a B in debt on this one. So you got to be comfortable with that. So here's our total debt. We talked about that, sitting at right at $150 billion last year, or at the beginning of the year, we were sitting at about 130 on that one. Now let's take a look at cash flows. Okay. We talked about how the cash on this company went down a lot. Okay. And so we've pulled down this 6-month net income number. It's sitting right at about $11 billion. Last year, we were at $9.1 billion. So nice tick up there on the net income. This company in particular, and other companies like this, has huge amounts of depreciation. Okay. They invest a ton of money into their equipment and those types of things, and they depreciate that over a long period of time. This is a non-cash charge, and we get to add back, believe it or not, $8.1 billion of that. We've got some employee retirement benefits. They actually have to take that away. Got some deferred income taxes. I've never heard of anybody having to defer income taxing but never having to pay them, so I wouldn't necessarily count that. But all things being considered, look, I'm not an accountant, and I don't draw these rules up, but net cash provided by operating activities came in at $20.4 billion. Last year, we were sitting at about $23 billion. All things being considered, very, very strong business from a cash flow perspective. And, look, we looked at this net income number. We look at $151 billion worth of debt, and you've got net income for the 6 months at $11 billion. Might seem kind of off, especially if you're a new investor. We got to keep in mind the cash flow actually generated by business over the last 6 months is $20 billion. So that is far more impressive when you take a look at that. Now, they have to invest a lot of money in this business. So capital expenditures for the last 6 months coming in at $8.7 billion. We talked about, or I don't know if I mentioned this, but they expect capital expenditures between $17.5 and $18.5 billion. And when you take a look at this $8.7 billion mark, that's right about in the middle there. So you'd expect, again, this is for 6 months. You'd expect over the next 6 months, they're going to spend about this amount of money again, about 8 to $9 billion, maybe even slightly over that over the next 6 months. So we've got acquisition of wireless licenses. We notice, look at this, we spent $1.8 billion on that last year. This year we had to spend $45 billion. There was a big one, I think it was back in March, where Verizon had to spend a ton of money, like $40 billion or something on one auction. And so that is where a lot of the cash went, okay? When we look at, obviously we had $20 billion worth of cash flows, but when we look at these investing activities, they had to invest in their business. They had to buy more of these licenses. $54 billion flowed out of the company just in the last 6 months on investing in the business. Gotta like that. When you looked at the growth from the top line, okay, we had nice solid growth, 11% over the last 3 months. If they can keep this up, I, as a shareholder and an investor in Verizon, don't mind at all that they're investing even more money into this business, because it looks like this business is paying off down the road. Now, we've got our financing activities. How'd they finance spending $54 billion in 6 months? Well, they borrowed a lot of money, okay? They borrowed another $31 billion. They did repay about $7.5 billion of that. They paid you, the shareholder, about $5.2 billion. They had some other paybacks of some long-term borrowings. All things being considered, they netted about $16 billion from their financing activities, okay? So take away the dividends, take away the repayments of debt, and take away this other, but you add in $31 billion of debt and some other asset-backed borrowing, you end up grossing positive $16.5 billion. Now, the business made $20.4 billion. Add those two together. Now, unfortunately, you got to subtract this $54 billion. That gets us down to increase, or in this case, decrease in cash of $17.4 billion. And if we come up here to cash and cash equivalents, here's where we negative $17.5 billion. So I just wanted to walk you through that, okay? When you come across other companies where you see this massive decline in cash and cash equivalents, and you want to know, well, where the heck did it go? All you have to do is come down to cash flows, okay? And notice where they got their money, where they spent it, and then you see the net increase or decrease in cash over the last 6 months. Now, moving on to the stock chart, this thing, if we stretched it back, I showed you here on the 5-year chart, this thing has basically been flat. We've been, now it's been flat, but channeling in a large range. This stock has been as low as $49, and it's been as high as $61, $62 just back in November of last year, November and December of last year. Now, more recently, we've been as low as about $54 on this one, and I had that marked out because that looks like where this stock wants to go. Okay, we have a high here, lower high, kind of a fake out here, but lower high, lower high. This one looks like it wants to go lower, in my opinion. It's basically just making that channel. I mean, we're just kind of channeling down this way, doing that kind of thing with this stock. Okay, and I would expect, or I would anticipate, this one continuing to go lower. Maybe in the intermediate term, we pop up above this trend, but it looks like this one wants to go lower. You come down to this $54 level with Verizon. You want to lock in that dividend and potentially have margin expansion. The reason why I brought up T-Mobile and AT&T and Verizon is that's what you're betting on right now. With Verizon, the dividend looks safe to me, but the capital appreciation would want to follow, because I think there's other REITs and other stocks out there that pay a reasonable dividend that I'd rather be in than hold a stock for 5 years and have it basically go sideways. What you want is margin expansion, capital expenditure here, and the way you're going to get it is by them re-rating the stock closer to T-Mobile. So whether or not that happens, I am not exactly sure, but if you're confident that it does potentially happen again, I think you're going to have an opportunity to buy this stock a couple dollars cheaper here in the coming months, lock in a nice dividend, and maybe potentially get capital appreciation on this one, although it has not been there over the last 5 years. Hopefully you guys enjoyed this video, maybe learned something. If you did, maybe hit that like button and consider subscribing to the channel. Got a lot of stocks that we're going to cover over the next couple of months. Hopefully you guys will enjoy them. Thanks for tuning in today. Good luck with your investments.